Imagine a U.S. economy suddenly cut off from its largest foreign lender. In the past decade, China was one of the single largest holders of U.S. debt. Its pile of Treasury bonds once exceeded $1 trillion. Today that figure is much lower, around $689 billion by late 2025, but still enormous by any measure. At the same time, America's national debt has ballooned past $38 trillion, so almost every 60 cents we owe is held by someone, often foreign investors. This means any change in who buys our debt matters. In this video we'll unpack how China funds America, what would happen if it abruptly stopped, and why the outcome might surprise you. When the US runs a deficit, spending more than it collects in taxes, it sells Treasury bonds to raise cash. China uses its trade dollars, accumulated by exporting goods, to buy these treasuries. In effect, China recycles its surplus dollars into a safe, liquid asset. This keeps Treasury prices high and US borrowing costs low, while preventing an oversupply of yuan that would make Chinese exports more expensive. In short, by buying U.S. debt, China has helped keep U.S. interest rates low, good for American borrowers, and the dollar relatively strong, easing imported inflation. But this system has built-in limits. China can choose to hold dollars as treasuries, or sell them to buy yuan or other assets. When China's economy slows or it wants a stronger yuan, it may reduce treasury buys or even sell bonds. Indeed, data show China's treasury stash has been falling steadily, from over $1 trillion several years ago to about $730.7 billion by mid-2025. That drop partly reflects strategic policy. Beijing has been deliberately lowering its dollar reserves and letting the yuan strengthen. In fact, one analysis finds China's divestment from treasuries has been underway for more than a decade. At the same time, China has been quietly boosting gold reserves and using more yuan in international trade, moves aimed at de-dollarization. Official figures confirm the trend. U.S. Treasury data show China's holdings hit a low not seen since 2008, roughly $730 billion in July 2025. That's down from over $1 trillion earlier. Japan and the UK have now overtaken China as the 1 and 2 foreign holders. China trimmed another $57 billion off its treasury portfolio in 2024. Meanwhile, China's foreign reserves actually held up, around $3.34 trillion, meaning Beijing simply moved dollars out of US bonds into other assets, like Chinese banks or gold. These shifts are part of a broader strategy. Beijing wants to reduce dollar dependence and make the yuan more international. For example, by 2024 nearly half of trade between China and Brazil was settled in yuan, and intra-BRICS currency trade topped 50%. China's share in the SDR, a proxy for reserve currency use, is only 2% versus 58% for the dollar. In sum, China can fund America, but it's quietly diversifying, a trend to keep in mind. What if China suddenly slashed its treasury purchases or started selling large amounts? In the short run, U.S. bond markets would feel the pressure. Basic supply and demand says less Chinese demand means lower prices for bonds and higher yields. U.S. interest rates would rise. Mortgage rates, corporate borrowing costs and government financing costs would all tick up. One estimate is stark. Each 1% increase in U.S. borrowing costs adds about $187 billion to annual interest expenses. Right now the U.S. already pays nearly $1 trillion a year just to service the debt. However, a Chinese sell-off wouldn't instantaneously break the system. The U.S. Treasury market is massive, $26 trillion plus. Other buyers exist, investors in Europe, Japan, the Middle East and even U.S. pension funds and mutual funds. In fact, in recent years foreign private investors like global banks and funds have been buying more treasuries as central banks pulled back. Analysts note there's already an army of dollar-hungry investors with 10-year treasury yields near 5%. U.S. bonds still look very attractive. So as one Reuters analysis puts it, it might be a whimper rather than a bang. One group of buyers simply replaces another. Yields spike, yields jump until enough buyers step in. We saw this in April 2025 when yields jumped 0.5% in a week, though some of that was driven by hedge fund flows. Dollar value. China selling treasuries means China is converting dollars to yuan. That tends to weaken the dollar versus the yuan. Some economists point out that a Chinese sell-off would almost certainly lead to an appreciation of China's currency and depreciation of the dollar. A weaker dollar can boost U.S. exports, good, but make imports pricier, potential inflation. It can also temporarily spook markets if it happens quickly. Safe haven flows. Paradoxically, a global shock, like a big treasuries dump, might send some investors into other, safe, assets, like cash or gold, creating volatility. But remember, even rising yields, at this point, mean treasuries yield 4 to 5%, which is still very high relative to other safe bonds. It's important to note that analysts advise not to panic. State Street and others emphasize emphasize that many large holders are already underweight U.S. debt and any move out of treasuries will be gradual. Historically, Americans themselves and allied investors UK, Japan, etc. buy most new debt issuance. For example, after the 2008 crisis, U.S. buyers and close allies accounted for over 80% of the increase in treasuries. In that light, even if China opts out, the U.S. can still sell bonds, just at slightly higher rates to entice others. In the medium to long term, if China sticks to reduced treasury buying, the U.S. would face higher interest rates on a lasting basis. That raises the government's interest bill, already near record highs, and likely cools the economy by making borrowing more expensive. It could slow home sales, business investment, and put downward pressure on inflation since credit gets tighter. For markets, it means stock valuations might be lower as future cash flows are discounted at higher rates. Geopolitically, a major Chinese retreat would mark a milestone in economic decoupling. The power of the dollar might gradually diminish as reserve managers diversify. There are talk of a new BRICS currency or more trade in yuan, and we've seen countries holding more non-dollar assets. Still, experts stress this will be a slow process. The dollar is used in roughly half of international payments, and most foreign reserves are still in dollars. Any erosion of its status would be incremental. On the other hand, a softer dollar from lower demand could benefit U.S. exports. One Brookings analyst noted that a weaker dollar would likely improve American manufacturing and growth, partially offsetting the pain of higher interest costs. In practice, if China dumping treasuries made our dollar fall, U.S. goods would become cheaper abroad, giving a boost to workers and companies. Of course, much depends on the speed. A sudden crash in confidence would be destabilizing, while an orderly decline could be absorbed. The 2010 analysis even argued that the net effect might be more likely to help the United States than hurt us, provided the adjustment wasn't chaotic. To summarize the economic trade-offs in rough terms: higher rates, government debt service rises. Each 1% on $40t is almost equal to $400 billion more per year. Consumers and businesses pay more on loans. Dollar moves. Possible dollar depreciation could fight deflation and boost exports, but also raise import costs. Deflation. Higher rates typically slow inflation, so it might actually ease price pressures. But if the Fed went too far, it could tip into deflation. Market sentiment. A confidence shock could rattle stocks and emerging markets short-term, though many now expect any sell-off to be gradual. The U.S. government would not simply sit still. Possible responses include fiscal discipline. Congress could try to cut spending or raise taxes to shrink the deficit. This reduces the need to borrow, taking pressure off rates. In reality, this is politically hard, but it's the textbook cure. Attract other buyers. The Treasury can sweeten offerings. Higher yields will naturally attract domestic investors and foreign pension funds, or even countries like India or OPEC states. Some advisors might engage allies to reassure them of U.S. bond safety. Monetary policy. The Fed might adjust its balance sheet, for example, by pausing rate cuts or even buying treasuries to stabilize markets, akin to a mini QE. However, the Fed's mandate is domestic price stability and employment, so its main job would be to keep inflation in check if fiscal policy loosens. Promote the dollar. Diplomatically, the U.S. could reinforce the dollar's central role by insisting on dollar-denominated trade, e.g. in oil, or through currency agreements. Financial sanctions and swift control also bind some foreign banks to use dollars. Economic growth. In the long run, a stronger economy will make U.S. assets attractive. Policies that boost productivity and investment, infrastructure, tech, education, help pay down debt faster. Dialogue with China. Engaging China on financial issues could also diffuse risks. Both sides have strong incentives. China still benefits from dollar stability, and the U.S. needs China's cooperation on trade and climate. In history, fears of running out of buyers have usually been overblown. Recall that even after the U.S. credit rating was downgraded and tariffs threatened in recent years, global investors quickly regained appetite once markets settled. The sheer depth of U.S. capital markets is a backstop. Conclusion: if China turns off the spigot on U.S. debt, the story is complex but far from catastrophic. The most likely scenario is higher interest rates for a time, with some volatility as markets adjust. Unlike a fixed budget household, the U.S. can always pay slightly more to borrow or shrink what it needs to borrow. Painful? Maybe a bit. Americans might pay more on mortgages and credit. Chaotic? Unlikely. Global demand for the dollar is still very strong. Analysts caution us not to fearmonger. They note foreign central banks have been reducing holdings in recent years, yet the bond market remained relatively unaffected by a mere shift to private buyers. In plain terms, even if China pauses its bond purchases, Americans and other investors would step in, albeit at higher yields. Over time, a slightly weaker dollar could make U.S. factories hum again while tempering inflation. In sum, the U.S. would feel the pinch in its wallet, higher rates, but it wouldn't lose its footing. So next time you hear headlines about China dumping treasuries, remember the bigger picture. The US has weathered wilder storms. Our economy's size, the dollar's global role, and millions of individual investors all matter. While China's choices influence the tides, they won't sink America's boat, they might just nudge it onto a different course. Subscribe for more updates.